Chapter 22, Section 2. A shaky stock market triggers a financial crisis. The purpose of the stock market is to provide businesses with the capital they need to grow. Business owners sell portions or shares of their companies to investors. By buying shares, investors supply money for businesses to expand. When all is well, the stock market is a useful tool in a capitalist economy. But all was not well in the 1920s. A speculative boom leads to a spectacular crash. The stock market boom began innocently enough. Businesses thrived in the 1920s. Manufacturers were making products that consumers were eager to buy. As Americans saw business profits growing, many thought that they could make a lot of money by buying shares in successful companies. The promise of financial gain drew new investors to the stock market. The result was a bull market, or a steady rise in stock prices over a long period of time. But investing is not a rational science. In the late 1920s, a lot of people were swept up in a wave of speculative enthusiasm for the stock market. Like Groucho Marx, these investors believed that if prices were high today, they would go even higher tomorrow. So they bought the maximum number of shares they could afford and began counting their paper profits as the price of most stocks went up. It seemed to many Americans that there was no limit to how high the bull market could go. Investor optimism was so intense that not only did people put their savings in the stock market, but a growing number actually borrowed money to invest in stocks. Borrowing money was easy to do in the 1920s. A buyer might pay as little as 10% of a stock's price and borrow the other 90% from a broker, a person who sells stock. The result was that someone with just $1,000 could borrow $9,000 and buy $10,000 worth of shares. This is called buying on margin. When the market was rising, brokers were happy to lend money to almost anyone. Easy borrowing encouraged speculation or the making of risky investments in the hope of earning large profits. Stock speculators do not necessarily buy stock to own a part of a company they believe will do well. They buy stock to make as much money as they can as quickly as possible. In a speculative market, a company's stock price does not go up because the company is growing. Prices rise because speculators want to buy a stock today and sell it for a quick profit tomorrow. As speculation drives up the prices of a company's stock, the total value of the stock may become worth far more than the company itself. Rising stock prices created a high-flying bull market without a solid foundation. When the market turned down, this borrowed money house of cards collapsed. As prices dropped, creditors who had loaned money for buying stock on margin demanded that those loans be repaid. Unfortunately, because of falling prices, most investors could not make enough selling their stocks to repay their loans. Many had to sell their homes, cars, and furniture to pay their debts. Even businesses were affected. Many companies that had invested their profits in the stock market lost everything and had to close their doors. Stock market prices peaked on September 3, 1929. After that, prices began dropping, sometimes in small increments, sometimes in tumbles, like the huge drop on Black Tuesday in October. By then it was clear to many investors that a bear market in which prices decreased steadily had begun. Fearful of losing everything, investors rushed to sell their stocks, pushing prices down still further. By the end of the year, investors had lost more than $30 billion, an amount that exceeded the money spent by the United States to fight World War I. A banking crisis wipes out people's savings. The stock market crash also hurt banks, triggering a crisis that unfolded over the next 3 years. To understand how stock losses affected banks, think about how banks operate. When people are prospering, they deposit money they do not need for day-to-day expenses in banks. The money they deposit does not just sit in the bank vault. Banks lend it out to businesses or other borrowers to earn interest. Interest is the charge made by a bank for the use of their money. Bank loans help people start businesses, buy homes, and plant crops. In the 1920s, banks got caught up in the same stock market fever that gripped the nation as a whole. Usually bankers lend money to businesses or farmers. But in the 1920s, they increasingly loaned money to stockbrokers, who in turn loaned that borrowed money to individual investors. When the stock market took a nosedive in October 1929, many investors could not repay the money borrowed from their brokers. In turn, brokers who had borrowed money from banks could not repay their loans. With bad loans piling up, banks stopped looking like a safe place to keep one's money. People who had trusted their money to banks had good reason to worry. Even before the Depression, it was not unheard of for banks to go out of business, wiping out the savings of their depositors. During the good times, between 1923 and 1929, banks folded at a rate of about 2 per day. Most of these failures were small rural banks. The stock market crash made this bad situation much worse. As the economy continued to falter in 1930 and 1931, large numbers of depositors lost confidence in their local banks. The result was a rash of bank runs. In a typical bank run, panicked depositors lined up around the block to try to withdraw their money. Those first in line got their money out, but once the bank ran out of cash, it closed its doors. An appalling 3,800 banks failed in 1931 and 1932. By 1933, 1/5 of the banks that were in business in the United States in 1930 had gone out of business, and millions of people had seen their savings vanish.